Good day, fellow investors. Last week we did the top 10 positions of the Vanguard High Dividend Yield ETF, and now I did another 100. So I went through all the lists, 10 pages, 10 times 10 is 100, and from these I selected 5 that I think are really interesting for discussions. Tomorrow and the day after we will discuss 2 even more in detail to add them to our YouTube portfolio, and then at the end of the video I'll put the appendix where I'll go through the lists and the comments that I've put. I think that you will enjoy also that too, but even if you just want the 5 interesting ones, please, for support of the channel, because if you look at YouTube, what they are looking is how viewers are watching this video, and if they watch it for longer, that is always better for supporting the channel, not to mention that we donate the proceeds that we make from videos. So I have just one request, that even after we pass the 5 key stocks from the 100, that if you don't want to watch the appendix, just let it run so that we get higher watch time on YouTube, of course with the like and subscribe if you haven't yet. That would mean really a lot. Thank you. And now let's immediately start with the top 5 ideas that I got from looking at 100 stocks. This is what I do. This is what I do on my research platform. Constantly look, analyze, follow those stocks over time, and then from those really understand the great investment buys, as we will add 2 of these positions to also our YouTube portfolio that we recently started. Links to all are in the description below, so you can follow, learn about businesses, understand better the risk and reward, and then see when it best fits you. That is the core of investing for me. The first stock is Verizon, and we discussed Verizon already a few times on the channel because it was a Warren Buffett buy, and then he sold the position to likely buy something else. But Verizon is a pretty stable business. It has its own deficits and benefits. So let's just dig into the financials, understand the risk and reward, and then it's about seeing how it fits you. So Verizon Communications, the stock price now is 50. Warren Buffett also bought around 55 and then sold somewhere there. You can see here pretty stable revenues. So stable, a little bit growing slowly and steadily, so likely they will be able to increase prices with inflation a little bit. Now with 5G, maybe higher average revenue per user, so slowly and steadily. They have also some volatility in those earnings depending on the tax benefits and everything, but pretty stable around 20 billion. And if we go to net income, we are now then again 20 billion. That's the value they create. Has been with ups and downs with costs, or they acquired here the minority interest. So we are now pretty stable at 20 billion if we look at that. Basic earnings per share around 5 now, and there are now cost pressures, so that is something to keep in mind, but this might go to 4, might go to 5, and the key is the dividend, of course. People are interested in the dividend here, so we are at 2.55, slowly and steadily growing, and when the capital expenditures for the 5G expansion subdue what they paid a lot for, I think that these dividends down the road might grow at a faster pace. That would be the bullish thesis here. Maybe Warren Buffett sold because the bullish thesis will not materialize there, but this is what we are looking at now. With cost pressures, with inflation, with businesses slowing down if there is a recession, of course this will be hit, but let's say the underlying stability is there. So if you look at the business, if you look at the 5-something% dividend, it is likely it will stay there, and then you have the upside if the 5G things works, elaborates, grows, and they manage to lower the capex from 2023, 2024 onward, so that they have more cash flows, to lower the debt also, and to increase the dividend, then you have something interesting. And if we go to our YouTube template, intrinsic value template. This is the free one. The premium one is on my research platform. So we have Verizon, we have analyzed it here. And if you look at the dividend per share, 2.56, if we put a 5% growth rate next 5 years per year, it will be ups and downs, I think. So maybe a little bit too exuberant, but okay, 10% when the capital expenditure subdue, maybe 10% discount rate does 10% expected return, and terminal multiple of 20 on the dividend, 100 divided by 20 is 5, so a 5% dividend yield, then you get an intrinsic value of 58. So it is there for a 9-10% return. If the dividend grows faster and the market is happy with a 4% dividend yield, then it is strongly undervalued. Worst case scenario, let's say no dividend growth, and then the market expecting a 6-7% dividend, but even if it stays at 5%, 35, so there is some room for decline. This is the risk and reward, and I would say, okay, fairly valued for 5% return surely from the dividend, and then it depends on the potential that they have to increase those dividends. This is Verizon, this is the risk and reward, and you have to see, okay, when they say from next year, from 2 years down the road, we'll be able to subdue the capex, then it will be the time to really buy or just watch for the dividend. So the downside is pretty stable, the upside there is potential. So pretty stable business. I cannot add anything to the YouTube portfolio, so because then it would be clobbered. Maybe later. For now, let's leave Verizon there. It's a good business, it is stable, it is a dividend play. 5% dividend, which is much higher than the 2.5% from the Vanguard dividend yield. So when you compare the dividends there and the likely long-term returns, then you already have something interesting. That's why I picked out that one from the 100 I looked. The next one is Starbucks, another one we already looked at. And interestingly, we looked at it when looking also at Verizon and 3M. So the risks are, of course, costs, pressures. It's a big company now, so wages, unionization, coffee prices, not because the margins are really big on those coffee prices. They pay 10 cents, you pay $5. That's the business. But it is really a strong brand and growing still globally. So that's the risk and reward there. And I want to discuss Starbucks and show you the McDonald's stock price chart. Why McDonald's? Because maybe Starbucks is on a good path if it continues to grow. So I remember looking at the stock McDonald's, it was at 19 here. I remember this was one of my first analysis that I made. Yes, I'm that old, sorry guys. But this was it. It was at 19, and then I thought, oh, maybe it is expensive, or I was just learning. But then it went even lower, and from then it is a 20 bagger plus the dividends over time. That's investing, and there will always be these negative times, so negative years, even 3-4 years of negativism. And if the business manages to solve the issues, then you are really looking at something. For Starbucks, it's now at $78. The market cap is big already, but if they just keep on trending up long term, slow and steady, then we are on to something from an investing perspective. Let's look at our comparative table where we have Starbucks here. So earnings per share is what I took for the valuation. If they grow at just 7% per year and they have a PE of 15, which is low for a company like this, the intrinsic value conservatively would be 55. If they grow at 9% and 20 PE, then we are at the present value of 79 for a 10% return. So maybe just still a little bit expensive to put it into our portfolio. Let me know when we are at 55, and then it might be very, very interesting. Will we get ever to 55? Maybe not. 58 we were here, of course, and now here 71, and now it starts already rebounding because of value. P ratio 20, dividend yield also 2.5, in line with the market. So nothing wrong. maybe now the risk and reward isn't as positive. At 50, 60, I'm sure I would put it in my portfolio, at least YouTube, to start following it and learning more about it. Now, the next company is Newmont. I'll do a special video for Newmont because when I do special videos for companies like Rio Tinto, I get also in the Google search for the videos, so that helps. And also I'm going to add it to the YouTube portfolio, so I want to have a clear link when I add it here, what I did, how much I added it, and why. So Newmont is a gold miner, the largest in the world, global, also after the merger with the African businesses. So very interesting gold dividend yielder. Of course, everything depends on the gold, but I really think that it is all about strategy when it comes to gold miners. So as you can see on the stock chart, it goes up and down, up and down. There are issues, there are less issues. Gold prices go up and down, and then you can't really predict. What you can do is take an all-weather perspective, as Ray Dalio says, and say, I will start here with X percentage of my portfolio. If it goes up, I will lower it back to the same exposure in the portfolio. If it goes down, I will increase it. And I think that Newmont is a big company, pretty stable from that gold perspective, production and everything. If gold goes down at 1,200, they don't make any money, so the stock will get clobbered 70%. But if I can add twice on that way down, when it rebounds, then I can make some returns on that position. And that's what I want to discuss and teach you about in the YouTube portfolio by following Newmont. So very interesting. I'll make, as I said, a video tomorrow then especially about Newmont, but it is interesting. The next business that we already covered in 2019, and when I said that it is a great business, it will give you good returns ahead, 87 years of dividends. Now we are at 91 years of paying dividends. So if you want stability, if you want a stable business, 90 years is something. Not even I am that old. So they started paying dividends and they didn't stop since Warren Buffett was born. That's something. And since 2019, if we look when I made the video, the returns have been pretty good. Now, I see there was, of course, exuberance with commodities, with foods, with everything, and now it's already down. So people see that wheat prices go down, and then let's also dump the stock because it won't go higher. But if we can eliminate the noise and focus on fundamentals, then there is already something pretty interesting here. Price earnings ratio 15, dividend yield of 2%, but when it comes to ADM, this is really about stability of the business. It's an essential business, so nothing wrong with it. Global business, and we'll also make the day after tomorrow, we'll discuss the valuation and everything, so that I have a special video also for search purposes, because nothing wrong with it. Good dividends, it is a good business. And now the key is to understand at what price it fits your portfolio. ADM is such a business that if the price goes lower, lower and lower, you can be pretty sure that you can add more to it. That's the key here. And when you find such good businesses, essential businesses, you got to it. I hope you got to the same day, so you don't have problems there. But that's life. ADM gives you that life. So core business, essential, boring business, you just need to see at what price it fits you, and we'll discuss that 2 days from now. Now, another business that Warren Buffett bought. So if we look at Stock Circle, now people said to me that it is reported for phishing and everything if you give them their email. I don't know, I have gave them an email that I use just for logins here on crazy pages, so I don't even check that. But it has a good picture on when somebody bought. So Warren Buffett bought the first here around 37, and then when it was announced in April, the stock jumped, added a little bit more later. Very interesting business. If Buffett is buying, must be interesting. And the risks there, of course, printers, PCs, are we going to buy them, continue to buy them, or are we going to buy something else, going to tablets, phones, or something less printing? But then again, with businesses, a business needs to have those printers, etc. So that's something. The question is how the business is going to switch to something else. They have acquired Poly, the headset phones, communication devices, so that they can integrate and combine it with their offerings now, which is a very interesting thing. So there might be growth. They are doing really good cash flows, but of course now there are headwinds coming from the great 2021. So if we look at the stock price, now it's even much lower than what Warren Buffett paid. Of course, you look at the P/E ratio, you say 5, that's extremely cheap. Dividend yield is extremely high. They did buybacks 10% of the company, but the stock is going lower because the market expects lower sales. And if we look at here, they have some debt. That's also something. They have 9 billion in debt and they are increasing that debt position. That's also something to keep in mind, because when things turn negative, then that really becomes an issue. When the cash flows are extremely high, that isn't an issue. But you can see here the change between Q2 2021 and Q2 2022. Free cash flow, just 351 million. If you multiply that by 4, we are at 1.2 billion. So the valuation is already at a price to free cash flow of 30, not anymore of 5, because it looks like it is slowing down. But they are really pounding on those buybacks. So 1 billion, 1.2 billion in the quarter. So if they keep just returning 3 billion on the market cap of 30 billion, that is 10% return. That is something stellar. And then also when the cycle again reverts, maybe then you have also potentially upside. But this is the business. Now it is under these negative pressures, especially if we have a recession, this and this. They are keeping doing the buybacks and this and this. But the long-term story is pretty stable, and that's why I think Warren Buffett bought. He saw the cash flows. Of course, it will be up and down, but on average, we have 1.5 billion people entering the middle class in Asia. And when you enter the middle class, your kid needs a computer, a printer, this and that, and plus they will maybe do some acquisitions, do more. So they have a pretty stable position in the business. That's the long-term attractiveness on a high cash flow producing business. There will be ups and downs, and we have to check on those downs. So if it goes even lower, so let's say it goes another 30% down, then remind me, oh Sven, this is lower, and then tell me, okay, the long-term story is still intact, everything looks good. Sven, please check HPQ again for maybe a lower entry point for our portfolios. But then again, nothing wrong with it. Buffett owns it, so it just depends what kind of return you expect. And in this case, you have to expect volatility in those earnings. Index, the other 95 stocks, and why I selected what. So the first here is Coca-Cola. So Warren Buffett stock, okay, it did really, really well. Now, not even that down from the upside, but this is a stable business. This is the most usually priced business. So price earnings ratio of 26, too expensive for me. Dividend yield of 2%, and people are looking at 3, 4, 5% growth, 7% return from a business like this. Nothing wrong for pension funds or something like that, but too expensive for me. Of course, it is good. They are growing globally, but slowly and steadily. So nothing wrong with that. They are even increasing market share, and they say they have huge potential, but they expect the industry to grow 4, 5, 6% with the 2% dividend. That's it. So okay, but not really for me, just too expensive, nothing special there. Then Broadcom, the semi-cycle, let's look what nobody likes it, still no capitulation there. Pharma is very expensive, as we already discussed. Pepsi, same as Coca-Cola. Verizon, we just discussed it. And then we have Comcast. So we discussed a few of these companies. It is very interesting from a free cash flow perspective. 17 billion on the market cap of 170 billion. So it is a price to free cash flow of 10, but maybe it will revert back to the normal. And then content wars and everything. The question is, it might be good, but do I want to become a specialist in this sector or not? Is it too competitive or not? So can I find better to research, to focus on things that are less risk, maybe better returns? You simply cannot analyze everything. That's also something to understand when it comes to investing. Cisco is a covered stock. You have it on free preview in my research platform. I'll put the direct link in the description below. McDonald's, it is big, but again, pricey like everything else. Walmart, wait for that retail to come down to normal levels and then start thinking about adding such a company. Intel, it's covered. I'll do an update now that earnings are coming in, so that's another one we cover on the YouTube channel. Banks, as I said in the video there, I don't do banks, simply easy. Linde, again, they are using that to do buybacks, which is good until it isn't. Philip Morris, tobacco, negative trends, they are now all going to the smokeless or whatever. Not for me. Pharma again. Texas Instruments in the cycle, watch the business cycle. Semis, watch the cycle. They are likely could do good, not a specialist. I'm focusing on Intel, which is enough for me. Dividend, the issue is, of course, that now a little bit less with the spin-off, so nothing wrong with it. Too crazy for me. Issuing shares, growing at all costs. At some point, the cycle might revert. All depends on the oil cycle. Amgen, another pharma business. Defense, again, I don't do defense. P24, nothing wrong. Huge business, again, fairly priced likely. Retail pharma, that's something very interesting. We'll see another one that is pretty cheap. I don't understand the political and everything, the pressures on that sector. Might be something to research in the future. Legacy business, dividend, but not being able to grow. Caterpillar, completely cyclical. If the businesses stop investing and this and that, then you buy this when it gets really cheap. Bank, defense, Citigroup, banks. Then we have Altria. Okay, again, the same as we said with Philip Morris. Then BlackRock. And I said ETFs are detrimental to your investing success in a video we made last week, I think. But then if I look at this, they expect decades of growth ahead for ETFs and index investing. Now it's just 11% of the fee-based wealth globally. They expect it to grow to 15 trillion in 2025. That's huge growth. So great for them, but for me this is just too crazy. And don't think I am invested in a small cap on my research platform that will benefit if this happens. Will benefit hugely if this happens. So I am invested in that. I know that people can be that crazy to invest and grow into this, so I'll make money on it, don't worry. But when I see this BlackRock, it's simply fairly priced likely, okay, but if the market doesn't grow at their expectations likely of 8% per year, this won't be 15, this will be 10. So you have to be very careful on what you price in when it comes to those investments. Automatic data processing, nothing wrong, but pricey. Insurance, interesting, as we already discussed. Big company, but slow company, so too slow. Now, Duke, all these utilities have a dividend yield of 3% like the Treasury, so that will move likely with the Treasury. 3M, we have discussed. Blackstone, depends on the asset under management. Blackstone, alternative investment manager, depends on the assets under management. Pharma, again. Utility with huge debt, they just discussed the debt. Oil cycle, Target, wait for those retailers for better risk and reward. Financial, this is a good one, again trading, but expensive it looks like. Financial, expensive, 3%, expensive, very expensive, so probably a good business, but a bit pricey. Financial, price earnings ratio 32, good for Colgate. Illinois Toolworks, watch the cycle. Schlumberger, watch the oil cycle for Marathon Petroleum too. General Dynamics, defense. Eaton is expensive. good business, Air Products and Chemicals, expensive. Newmont, we discussed. Ford Motors, I will make a car video because so many are interested in these cars, but watch the car cycle. I'll make it another one in detail. Fuel cycle for Valero, again. Emerson Electric, watch the cycle there, the yields there. Sempra Energy, stable 3%. Here we come to the utilities, 3.29%. Exelon, 3%. So nothing wrong, but in line with treasuries. Devon oil cycle, ADM we discussed. Dow, watch the cycle. This is really commodities businesses, so nothing special. Watch the cycle there for better entry points. Defense, as I said, I don't really do. Insurance, Williams Natural Gas, Kimberly-Clark, good, looks fairly priced. Travelers Insurance, Cisco Corporation, interesting but pricey, exuberantly priced now. Covered, we will check it again. 3% utility Excel, Prudential Insurance, Paychecks, watch the business cycle. Again, another insurance, Aflac. Then we go to Kroger. We discussed it in 2017 and recently 8% likely return ahead. Now it looks like a little bit more price expensive. So just look at when the retail reverts from the pandemic boom. Now, Kinder Morgan, I've looked at it. I know there is something that I miss with these mid-streamers, and I don't know yet what. I've looked, I have a 40 page report on my research platform, but something I'm still missing, I'm failing to grasp there. And then you say simply, okay, next, maybe I'll come back in a year or 2 years to re-look at it, but I can't grasp it. They keep investing a lot. So growth capex, but where? What's there more to grow? So there must be something behind that growth capex, so that I still don't get. That's simply, I cannot get everything. So Johnson's Controls International, watch the business cycle. Nucor, watch the steel cycle. Philips 66, again, watch the cycle there. 3.3% utility. Consolidated Edison. DuPont, watch the business cycle. 3.48% for public service enterprise, another utility. Bank of New York, bank, of course. International flavors and fragrances, the market got excited, so it's pricey. 2.89% dividend yield for WEC, energy utility. Insurance, Arthur J. Gallagher. Discovery Financial Services, it's finance. M&T Bank, Eversource Energy, 3.04 dividend. This again, the Walgreens Booth Alliance, pharma retail, getting interesting, looking interesting. What is it that I don't understand there is also something that I might look into in the future. You never know. You go through these lists and you see Hershey, pricey, likely good, but pricey, and this is finance. So I hope you enjoyed this overview. I really enjoy doing this. This is what I do most of my time. Just look at businesses and then analyze, focus on those businesses that are really, really good, that I think can add value over the long term and maybe at some point in time become great buys. That is what we do now here on our YouTube channel. That's what we will do next. So I really hope you enjoyed this. Thanks for letting the video run, and subscribe. Tomorrow we discuss Newmont and ADM, so I'll see you tomorrow.